Hello and good morning, everyone. Thank you for joining us. We are so looking forward to our new 2022 Secrets of a Successful Retirement series for this year. I don't know if you were with us last year, but we had a great 12-part series that we did last year of webinars. And if you ever want to look back, you can always go to our website, and under resources, you can find the webinars from last year. But this year, we're going to be doing a bunch of really interesting topics. We'll be touching on some we did last year, but then including a bunch that are new. And one of the new ones this year is the one we're starting with today, which is all about inflation. My name is Tara Kendrick, and I'm here with Bill Witt, and we just want to give you a little overview of our business and how we help people. So we work in 4 specific areas. We do comprehensive retirement planning. We look at tax planning and just ways to pay less tax. We do a lot of long-term care planning and then estate planning. So we help in multiple ways, and we'll be touching on all the ways that we can help folks over the course of the next few weeks with these webinars. So to start us off, Bill is going to introduce the overview of each of the webinars we'll have over the next 15 weeks. Take it away.
Thanks, Tara. Hey, my welcome too. Appreciate everybody joining us today. The topics that we're going to be talking about are topics that are actually included in the 2022 version of our book, More Money for Retirement. Tara and I have been doing retirement planning since 2002, and over the years we've learned a lot, and we put all the things we've learned, the nuggets of wisdom, into a book. And by joining us today, you can receive a PDF copy of the book. Tara will send out a copy. But if you'd like a printed copy, all you have to do is drop us an email, and we're happy to mail you a printed copy of the book as well. Some people prefer that. I like Audible books, but you can get a printed copy. So today's topic, as Tara mentioned, we're going to talk about something that we haven't seen in many years, and that's inflation. And we're going to talk about the causes of inflation, some of which have been talked about in the press, but some of which haven't been talked about, and I think may actually give you some pause when you understand what the government has been up to over the last 10 or 12 years. Next week, we'll be talking about a very important topic, how to maximize Social Security benefits. Social Security is an important source of income. It increases with cost of living, so it helps keep up with inflation. And we're going to talk about how to make smart claiming strategies. The following week, we're going to talk about another important area. Most of us have retirement accounts, IRAs, 401ks, and these accounts, for most of us, have to get us through retirement. That money has to last as long as we do. We're going to talk about some creative strategies for how to get free money from your retirement accounts. And with a little planning, you can actually make it tax-free money, getting tax-free money from an IRA or a 401k. The following week, we'll talk about Medicare. Most of us turning 65 are eligible for Medicare. And as we all know, the cost of medical expenses continues to rise. So we're going to talk about the different Medicare options and, more importantly, how to make smart choices. The week after that, we'll touch on long-term care. We carved that out as a specific area within our practice because that proves to be one of the most expensive risks all of us are going to face. We're all living longer, and the consequence is we have to pay for long-term care at the ends of our lives, and it's gotten frightfully expensive. So we're going to talk about solutions where we get the government or private insurance to pay for long-term care. Then on March 22nd, we're going to have a talk on what I call David versus Goliath. Over the last 18 years, Tara and I have helped a number of clients deal with large organizations where they've been wronged. Might be a large bank or credit union, could be an insurance company, a brokerage house, or it might be a governmental agency. And you know, when you take on Goliath, these organizations have large legal staffs. You can't attack frontally. If you do, your cost legally to hire lawyers would be outrageous. But Tara and I found a number of strategies for getting Goliath to rethink their position and oftentimes get the benefits that people deserve. So tune in for that. The following week, we're going to talk about tapping home equity. And we've got 3 strategies for how people can use their homes as a way of supporting their lifestyle in retirement. One of those includes a way to take tax free money out of home equity. Um, the week after that, we're going to be talking about taxes, and taxes are rising. If you don't know it, the Trump tax cuts are going to expire in 2025. And with governmental expenditures continuing to exceed revenue, uh, I think we're probably into a time period where future administrations are going to be raising taxes. So it's important to figure out where we pay tax and to see if there's ways to use the tax rules to our advantage. The week after that, we're talking about critical legal documents. Tara and I are not lawyers, but we've seen the impact of what happens when people, when their health fails and they don't have powers of attorney or they don't have directives to physicians. These can be very expensive situations where people are forced to go through guardianship. Uh, when you die, if you don't have the right legal documents, your estate has to go through a process called probate. And there's easy ways to avoid probate. So we're going to talk about critical legal documents that everybody should have uh, to protect their wishes. The following week, we'll talk about income. And when you get our book, you'll see that Tara and I are strong proponents of having guaranteed income in retirement. That guaranteed income ensures your lifestyle, your security in retirement. It's just like when you're working, you have checks coming in every month. And so we're going to talk about strategies about how and why income is important, and then ways to create more income in retirement. The week after that, we're going to devote a webinar to people under 60. Folks under 60 have some other opportunities for creating tax free money in retirement, and we'll touch on that. So if you have a son or daughter or a neighbor or friend that's under 60, this may be an option for them, something that they may want to listen to. Week after that, we'll talk about avoiding probate. Not expensive in Texas, but if we can avoid it, we can save money and time. Um, on May 10th, we're going to talk about modern annuities. And I've made a statement in my book that there's been more improvements in annuities in the past 10 years than in the prior 2,000 years. And that's kind of a bold statement, but we'll explore the pros and cons of annuities and see if they have a fit in your retirement planning. After that, we'll talk about disability planning. Sometimes people become disabled before full retirement age, and they have to tap into either Social Security or private disability insurance. And we found out over the years that going after these benefits can be very challenging. So we're going to bring in one of our trusted partners to talk about how to go about attacking the Social Security Administration and private insurance companies to make sure you get disability benefits. And then our final webinar, what I call Plan B, is going to be kind of a summary. Uh, there's a lot of unknowns in the future. And if some of these things come to pass, I think we're all going to need a Plan B, a default plan, just in case. And so hopefully we'll cover some topics that'll be of interest. So before I start today, I want to just read a quick disclaimer. And this is true of all of our webinars. All the content that we're going to present is for informational purposes. It's not intended really to provide financial, tax, or legal advice or to provide the basis for financial decisions. It's informational. The opinions expressed herein are solely those of Senior Resource Center, of Tara and Bill. And all information and ideas should be discussed in detail with your financial services professional before making any financial decisions. Finally, Tara and Bill, we are not securities licensed. The types of investments we deal with are what I call safe money, where we don't have the risk of stock market corrections and other downsides. So, with that, let's kick it off. So, what's our topic today? We want to talk about inflation and why it's a problem, and then the underlying causes. And in a nutshell, inflation reduces our buying power, and it also impacts the value of money that we have in the bank. If inflation goes up, the value of what we have in the bank is going down. The buying power of it is going down. My wife is a retired teacher in the state of Texas. She has a fixed pension. And today it provides a nice amount of income that supports her buying habits. Uh, but what if we go through a round of 10 or 20 or 30% inflation? Since the pension doesn't increase, her buying power will actually decline. And so it's something we have to plan ahead for. And it's one of the things Tara and I plan ahead for when we build retirement plans. Here's another way of thinking of it. Think back to what you paid for your first car. How much did it cost? What about the car you own today? Well, in my case, my first car was a 1967 Volkswagen Beetle. I think it had a sticker price of $1,635. It's an economy car. It got good mileage. Today, I drive a 2022 Toyota Prius. It's a wonderful car. It's got a lot of self-driving features, but it's still pretty much an economy car. Gets 63, 64 miles to the gallon. But $1,600 years ago to now 40, I spent 40,000, almost 40,000 on my new car. That's the impact of inflation. What did you pay for your first house? How about the house you're in now? I'm sure it's a much more expensive home today. So this is the impact of inflation. Over time, everything gets more expensive. Here's a history chart that shows the history of inflation over the last 110, 115 years. And you'll see there's a number of periods that where inflation was very dramatic in this country. The first one was back during the 1916, 17, 1918 time period. Then we had another spurt of inflation in the late 30s and early 40s. And then there's a third round of major inflation that most of us remember back in the 1970s. And we're going to look at each one of these events, but I want to talk first about the causes of inflation and see if there's some parallels with where we are today. And as you can see, right now, our inflation has risen. We're probably up higher than it's been in the last 30 or 40 years. So the question is, what's driving it? How much higher might it go? And what can we do to protect ourselves? So, what causes inflation? Most of the commentators today we hear on the news talk about the COVID pandemic as being the cause of today's inflation. You probably hear the term supply chain disruptions. There's no question that when supply chains are disrupted, when the normal supply of goods is compromised, that people are willing to bid up or pay more for the existing materials that are available. They're building a number of homes in my neighborhood out in Vernon. And I've talked to some of the homeowners that are in the process, and they tell me some pretty shocking stories about how much more electrical wire or lumber or building materials are today than where they were 4 or 5 or 6 years ago. Prices are up dramatically. But I think that there's some other factors. And if you ask economists what the driving force of most inflation is, they actually don't cite supply chain disruptions. They look at two other factors. Those factors are the impact of government deficits when our federal government spends more than it makes. And secondly, when the government expands the money supply, when it spends more money. And I have some charts that when I first put these together, these charts were in the original version of my book back in 2020. And I had a chapter in the book on inflation. And when I showed the charts, I said, this kind of gives me the concern that we may be experiencing some inflation caused by these two trends, government deficits and expanding the money supply. Sadly, my fears have kind of come home to roost. We're now seeing, I think, the results of what we talked about back in 2020. This first chart shows the relationship between our federal national debt. Today it's up in the high 20 trillions of dollars. And it's comparing the size of the federal debt to our gross domestic product, or the production of our country. And economists use this. They go, how does our deficits, we run deficits almost every year. The question is, how does the gross debt compare to the gross production of the country? Are we keeping them in parallel? And I think what this chart shows very dramatically is we aren't. The high water mark in the history of this country was set back in 1945. Why was it? It was the end of World War II, and we were spending a huge amount of money on building aircraft carriers and bombers and tanks to win World War II. Well, since that time, the percentage of debt to gross production went way, way down. But you can see over the last 20 years, 30 years, 40 years, it's been rising. And in 2021, for the first time in the history of this country, we've set an all-time high rate. It got up to 135%. In other words, the national debt, our rate of spending more than we make, is exceeding the gross production of our country. And that's worrisome. That means our debts are rising faster than our ability to produce as a country. The second chart, to me, is even more worrisome. What this chart shows is the Federal Reserve's balance sheet. And let's talk about what this represents. The Federal Reserve back in 2007 and 8 had a balance sheet. They owned about $850 billion of debt, of either government or corporate or private debt. And through the history of our country, the way the Federal Reserve has typically fought inflation is by raising interest rates. Well, what happened in 2008? The economy went into a great recession, and to try to stimulate the economy, first the Federal Reserve dropped interest rates. They brought it down to near zero. But the economy didn't recover. We were stagnant. So the Federal Reserve started doing something. They put a fancy name on it, but they started doing something they hadn't done excessively before. They call it quantitative easing. And let me tell you essentially what that means. The Federal Reserve started buying U.S. government debt. Let's play this out. Our government spends more than it makes. We know that. And they sell bonds to cover the shortfall. Who typically has bought the bonds over the last 30 or 40 years? Other governments like the Chinese, maybe European countries, and private investors in the United States. People go out and buy U.S. government bonds and earn interest on those bonds. Well, what happened in 2008 was the Federal Reserve dropped interest rates, and it didn't stimulate the economy. So in order to try to stimulate the economy, the Federal Reserve became the primary buyer of government debt. And that's what this chart shows. In 2008, the Fed owned about 850 billion of private and government debt. Today, that number is well north of $8 trillion. Well, how does the Federal Reserve buy all this debt? They essentially print money. What they've done is expand the United States money supply by almost $8 trillion over the last 12 or 13 years. Let me do an analogy. You're at home, you get your credit card bill, and you realize, gee, I spent more last month than I expected. This is kind of tough. I got to pay this. So what do? You go in the bedroom and you print out some $100 bills. Oh, wait, you can't do that, can you? No, because that's illegal. We can't print money, and businesses can't print money, and state governments and city governments can't print money. But here what we have is the federal government spending more than it makes, and then another federal agency that has the ability to print all the federal money that it wants, the Federal Reserve, prints money to buy the debt. Does this make you feel uncomfortable? It makes me real uncomfortable. It says that not only are we spending more than we make, but the way we're holding on to that debt or surviving it is just by printing more and more $100 bills. I think this is a real problem. These are the charts I showed in 2020, and I said, boy, these trends don't look good, and they're only heading further in the wrong direction. This last week, I was listening to one of the morning talk shows on Sunday morning, and they had the president uh, of the San Francisco Federal Reserve Bank on. They were asking her some questions, and they said, do you favor raising interest rates? Well, yes, I do. And they said, that'll cool the economy off and hopefully slow down inflation. But when they said, are you willing to back a 0.5% increase, which is pretty small, she said, no, that's too high. And I truly wonder, is the Federal Reserve under recognizing the impact of what's going on right now? We have a trifecta. We have supply chain disruption, we have massive government deficits, and we have a federal agency, the Federal Reserve, printing money like gangbusters. These three things, when they work in concert, they can cause inflation. So let's go back to our chart that I showed you earlier. Let's go back to 1918, 1917. What was going on in our country back in that time period? Two things. We're in World War I, which means the government was spending more money than it was making. And secondarily, we were going through a pandemic. And I don't know if they had supply chain disruptions, but I'll bet they did. I'll bet there were consequences. The war effort was going on, and usually when war efforts are going on, goods at home are being rationed. That's what happens in the late 30s and 40s. We go through the Great Depression, the government spends a lot of money, and then if you look at that second spike around 1945, what's going on? The government's spending tons of money, and we had government restrictions on buying butter and buying certain commodities, which meant people were willing, black market, they were bidding up the price of commodities. So supply chain disruptions, government deficits. What about the 1970s? Well, that's when the Arab countries decided they would use oil as a bargaining chip, and they cut supplies. I don't know if you remember, I had a diesel rabbit at that time, and I was fortunate. The diesel supplies, if you go to a truck stop, were available, but a lot of gasoline stations had long lines where people were trying to get gas because there were shortages, because the OPEC was restricting the supply of gasoline coming to the United States. So what's going on now? We see the line starting north again. Two of the factors are obviously government deficits, which are out of control, paying all this money for pandemic stimulus, and we've got supply chain disruptions. But we add on the third factor, and this is the kicker. It's what the Federal Reserve is doing. It's buying up all of this government debt. It's printing more and more greenbacks to support the spending habits of the United States government. I think we've got a really serious inflation problem in front of us. And so let's talk about, what's going to happen. So how does the Federal Reserve typically fight inflation? We haven't seen it since the late 70s, but back in the 70s, I don't know if you remember, they started raising interest rates. And back in that time period, we had CDs that were paying 15 or 16%. We had home mortgages that were 15, 16%. We had inflation running around 20%. And so the Federal Reserve cranked up in interest rates to try to slow the economy down, to try to stave off inflation. And that's what the Fed is talking about now. They're talking about probably 3 rate increases this year and probably 3 or 4 next year to try to put the brakes on inflation. Well, what happens when interest rates rise? Remember, I'm not securities licensed, so I'm just going to give you my opinion. But I think something that we could well see in the next couple of years is that bonds may lose value. So what are bonds? Bonds are financial instruments that are typically seen as very safe investments. They pay a fixed rate of return. You get a government or a corporate bond that pays, let's say, 4% or 5%. And every quarter you get quarterly interest. You buy the bond and it pays out over 10 years or 20 years or whatever the term of the bond is. Well, why would bonds lose value? Well, how do bond values work? Let's step back and ask that question. The value of a bond operates inverse to interest rates. What do I mean by that? Well, when interest rates are declining, the value of a bond goes up. And vice versa, when interest rates rise, the value of bonds typically falls. Why is this? Here's a simple example. Let's say I buy a bond that's paying 5% interest, and interest rates drop. So now the new bonds are only paying 4% interest. Well, people will pay a premium for my bond because it pays a higher rate of return. So the value of my bond goes up. But what happens when interest rates rise? Typically, bond values fall. So where are we in the cycle? Interest rates have been dropping since 1980, and today they stand near zero. They can't get any lower. I mean, unless they go negative, that isn't going to happen. But they can go up. And with inflation, the Fed has announced it's going to start to raise interest rates. So people that have done very well in bonds could well see the value of those bonds decline because interest rates are rising. Something to be concerned about. Another question is, what's going to happen in the stock market? Stock markets are like riding a roller coaster. They rise over a period of time, then they have corrections, they rise again, they have corrections. And this has been the history of stock markets for 150, 200 years. What happened in 2000? Well, we had the dot-com meltdown where everybody thought dot-com was going to pay off quickly, and it took much longer for it to prove its merits. And there was a big correction in the stock market. And then in 2008, what happened? People got into bidding up the price of real estate. People were flipping homes and not living in them, just buying and selling. And the price of real estate soared into a bubble. And then they introduced mortgage backed securities, which were not a good idea. The end result was we had another major stock market correction. Well, what's happened since then? The markets have been pretty much on an upturn swing. They've been rising for the last 12 or 13 years. Now, one thing I know about stock markets, the markets don't like uncertainty. Uncertainty breeds fear, and when people get scared, they pull back, they get out of the market. And I look at the world around us today, and we've got what's going on in Ukraine. To me, it's worrisome. We've got Mr. Putin with a lot of tanks and a lot of personnel near the Ukraine border threatening to invade, and we've got a lot of other nations worried that he probably will or might invade. That's uncertainty. We also know that the Fed, while they've announced rate increases, they haven't said how much. And as interest rates rise, people that are in the market sometimes pull out and go, if I can get 5 or 6% safely in a CD or in some kind of other financial instrument, why would I risk my money in the market? So it may undermine the potential of where the stock market goes in the future. We may be, after 12 years, 13 years of increase, we may see a market correction. Don't know, but I think it's something to stay tuned and be aware of. So, what can we do to offset the impact of inflation? I have two suggestions today, and we'll kind of develop the second one over the next series of weeks as we talk about other strategies to build a safe, secure retirement. The first one is real simple: own or invest in real property. So, what is real property? Your home, land, physical property. Well, why does real property, how is that safe? Well, if I own a home that's worth 300,000 and we have 10% inflation, my home is going to track the inflation rates. It's going to now be worth what, 330,000. And so real property tends to parallel inflation. If inflation goes up and we have increasing cost of materials, if materials cost more to build a house, my house costs more. And so therefore my property rises with that. So if you've been in the Austin real estate market in the last 2 or 3 years, you've seen the significant increase in property values. And that's good if you're in a property, but if you're trying to buy in as a first time homeowner, not so good. What's the second shield that you can have for inflation? And this is one Tara and I spend a lot of time on. When we build retirement plans, 20, 30-year retirement plans, we have some very powerful software that does this. We found that people that have more guaranteed income in retirement have better financial outcomes. And these models that we build continue to show us this. So we found that people that have or can create more guaranteed income in retirement, just like when they're working. If you're working and you have a paycheck coming in, you feel good. You can pay your bills because you have money to pay for it. But what if you get into retirement and now you're living on that 401k or you're living on your social security check? You're going to need more guaranteed income to support your lifestyle. And if there's inflation, like my wife, she's going to need more income 10 years from now than she does today with her fixed teacher's pension. So Tara and I have a number of ways to create more guaranteed income. The first one we're going to tackle next week. And that's talking about ways to maximize your Social Security benefit. When we get into this discussion, you're going to find that you have different timing options on when you claim Social Security, and you have options on which benefit to claim. You actually have most married people have three different benefits: their own benefit, a spousal benefit, or a survivorship benefit. And so we're going to talk about ways to make smart Social Security choices to maximize lifetime income. The week after that, we're going to talk about retirement accounts. Most of us have 401ks or IRAs. When we turn 72, government says, Bill, you got to start taking money out. Those are called required minimum distributions. We're going to show you a very creative way to use part of your IRA or 401k to satisfy the entire RMD amount. And if we do it correctly, we'll actually show you a way eventually where you can get free money from your IRA or 401k. So tune in 2 weeks. We'll show you how to create free money in retirement. Oh, and it gets even better. There's a way to flip it where you can turn that free money into tax-free money. So if you have a 401k or IRA and you know that usually when you take any dollar out, you got to pay taxes on it, we'll show you how to convert that to tax-free income. I think you'll like that. And the last area is kind of a collection of the other topics we're going to touch on. Tara and I view retirement planning very simply: increase what's coming in and reduce what's going out. Well, what's going out? Well, you got to pay for medical expenses in retirement. We'll talk about ways to reduce those. Most of us are going to encounter some level of long term care before we go to the pearly gates, and long term care is expensive. We're going to talk about ways to avoid this expense. We touched on taxes earlier, that they're probably going to rise in the future. What if there's creative ways using the tax code to pay less tax? Tara and I have strategies. We explain that to our clients. We look for ways to reduce investment fees. If you're having a financial advisor and you're paying them an annual fee, and if you're in mutual funds, you're probably paying the mutual fund company some fees. If there's a ways to reduce those fees, that's more money in your pocket. And last but not least, we'll talk about how to avoid legal events that can be very expensive by just having some simple legal documents in place. So stay tuned for future webinars. We'll show you how to create more guaranteed income and how to reduce expenses so that we can be prepared to deal with whatever inflation comes our way. So that's our webinar for today. Tara.
All right. Well, if anybody has any questions, up at the top there's a talk bubble, and you can type your questions into the talk bubble, and we'd be happy to answer them. And just so you know, if you joined us a little bit late or had to leave a little bit early, at any time in any of the webinars that we have, we'll always be sending anyone registered an email following up each webinar, and we'll have a link to a recording. And then later in the week, we'll have it posted on our website under resources. So you can always go back and listen to it again, send it to a friend, whatever you think. So if you have any questions, please feel free to pop them in the Q&A box. So we do have a couple. Okay, Bill, what should I do with my bonds?
Mildred, that's a good question. Let's see. Well, number one, we're not securities licensed, so I can't tell you what to do with your bonds. But if your financial advisor, if you're in bonds right now and you haven't had a call from your financial advisor and a discussion about what the Federal Reserve is planning to do and probably planning to raise interest rates, I think it might be a real good time to have that chat. By now, they should have called you because the Federal Reserve has gone on notice saying, we're going to raise interest rates. We don't know how much or how long, but if interest rates go up, probably the value of bonds is going to go down. And so that would be an excellent time to have a chat. Tara and I don't deal with investments that lose money, so we're looking for ways to try to build a safe, secure retirement plan where you control the outcome. Many people are in the stock market, which is wonderful, but if the stock market corrects, we don't control that. And I like building a safe, secure foundation in a retirement plan where you do well no matter what the markets do or what interest rates do or what the Federal Reserve does. So,
okay, good. All right, next question is, can you talk a little about capital gains?
Yes. Well, most investments that we buy into, if you hold that investment and it rises in value over time, you owe a capital gains tax when you sell it. Uh, Most people have heard about long-term capital gains, and those are ideal. If you, let's say you buy a share of IBM and it goes up and you sell it within the first year, that's normally considered normal income. So whatever tax bracket you're in uh, will determine the tax rate for the sale of that asset if it's done during the first year. But after the first year, we have capital gains rates that are generally less than the normal tax rates. And we've got a whole webinar focused on tax planning where we talk about the various rates that we pay on income tax. And, not all income is taxed at the same rate. Some is taxed at 10%, some at 12%, some at 22, some at 24. And there's ways of using the tax tables to our advantage. But if you're holding assets that have capital gains, and you sell them after that, after holding them for a year, you will owe a tax on that. Some of the capital gains rate can be as low as 0%, and I think as high as 20%. And it just depends on your situation. So if you have questions about that, you want to see the impact on your tax bill for 2022 that'll be due next year, come see us. We have software where we can plug in what you're planning to do and see how it might impact your overall tax situation.
All right, good question. Okay. Last is, you talk about getting a digital copy of your book. How can we get a hard copy of the new book?
Real simple. Send us an email. Mine is Bill, Bill, at SRC Texas, spelled out TEXAS.com. Tara's is Tara, TARA, at srctexas.com. Send us an email. Happy to mail you a copy of the 2022 version of the book. This has been updated. All of the numbers are updated for this year. So the tax planning tables that are in there, the Social Security numbers, Medicare numbers, VA and Medicaid numbers, all of those have been updated for 2022. And the nice thing about the book, it's a quick read. It's about an hour and 10 minutes, and you'll understand all of the different areas that impact retirement planning. So we would welcome, happy to send you a PDF. Tara will send those out today, but a lot of people like to have a physical copy of the book. And after you get the book, uh, you know, after you've had a chance to read it, if you like it, give us a call, schedule an appointment. Our consultations always free. Happy to offer advice and counsel and answer questions. And think about the book as a gift. You might pass it on to a son or daughter or neighbor, where you could also benefit their retirement planning. Never too early to start planning ahead to make sure our money lasts as long as we do. So, Tara, I think that's it for today. We're on for next week. It'll be Social Security. So, thank you, everybody, for joining us, and we'll see you next week.
See you next week. Bye bye.